All right, hello traders. Welcome. It is Wednesday, October 2nd, 2024. Good day in the markets overall today. Yes, mini E-mini futures up 0.13%. I mean, not a huge update, but an update nonetheless after yesterday. So holding on there, just not doing anything, just in this nice consolidation range sideways. We'll take a look at that. So I've got lots of good stuff to cover tonight. So number one, we'll take a quick look at some of the markets. We'll see what we're trading. But number two, I really want to talk about trading strategies and having different buckets for your accounts. And I really want to focus on number one, a trading account. And then we're going to talk about a little bit of a larger account, which is more your long-term, maybe investments and a growth style account. Now, that doesn't mean we're piling it all into mutual funds or something like that, but we're definitely not going to active trade that. So really, we always should be separating our our piles of money, okay, into multiple buckets. Technically, there's 3 buckets. So I'm going to cover 2 of them today. So stay tuned for that. And I'm really going to focus on the smaller trading account or trading account strategies and how to set that up. And then we're going to talk a little bit more about the larger, slower growth, safer type of investing account. And there's a definite difference between trading and investing. And a lot of times I think the line gets blurred because people see all this money potentially being made, and people on Twitter and people on YouTube, myself and others, having good success with something, and then they pile everything into it. Well, I like to keep my money segregated into different buckets as well. It helps you manage risk, number one. But number two, it just takes a different mindset in each different account. So I want to make sure we're really clear on how we're setting our buckets of money or our buckets of assets up when we get into it. So we're gonna, there's 3 of them. We'll talk about 2 of them, primarily the third one we really won't get into today. So stay tuned. I'm going to cover that with you. But first, let's talk about the markets. We'll look at our main trading account first, and then we'll get into the different buckets on discussion-wise. So let's jump in. We'll look at charts briefly here. So as I mentioned today, the E-mini futures up $8.25, 0.14%. So just a minor little update here. And without trying to get too many different drawings on here of different style, we are definitely in a bit of a consolidation range, not to be confused with this gap down here. And maybe we'll take this particular gap and let's change this thing, and we'll change the color of it a bit. Okay, so there's our gap. Probably doesn't differentiate it from some of these trend lines very well, but either way, you can see gap there to get filled. We'll see if we can fill that gap. Maybe we'll change that thing to something slightly different, just to make it easier for everybody to see what's going on. All right, there we go. Okay, all right, so a little bit of a gap there, but we've been in this trading range now for about 2.5 weeks, where the market's just trending sideways, not doing a whole lot of anything there, which is all good. I mean, it's nice to run up, take a break, and then see if we get any continued move to the upside, or if we start to roll over. I talked about some of the warning signs yesterday, some of the reasons I'm a bit cautious right now, but again, bullish but cautious. And I think just be smart with what you're doing right now. On the weekly chart here, things look still pretty doggone good as we're just moving higher, stair-stepping higher, higher highs, higher lows, all of that. Good support levels that we're at. We're trading above all of our moving averages. They're all moving higher. Momentum is to the upside, but we are definitely getting towards an overbought scenario, but still good momentum to the upside. Here on the daily, the momentum seems to be coming out, but we're just trending sideways. RSI is falling a bit, MACD is falling a bit here, and then stochastic momentum is tipping over. Hasn't broken down through that positive 40 mark yet, but certainly starting to pick up a little momentum to the downside We'll see. Do we get any more downside? Can we hold here? We can certainly stay in this overbought zone for a while. But again, I'd be a bit cautious here. Do we want to come down, fill this gap? There's some support that we're right above. There's the 200-day in green here. There's also the 50 moving average down here around 5,600 and change. We held levels today pretty well. We'll see what happens tomorrow, but a decent candle finishing off of our lows of the day and finishing up at least a little bit on the positive side. Oil continues to bounce and crank its way higher. Definitely buoyed by the Middle East conflict that's going on, Israel, Iraq, Lebanon, all of that stuff that's happening over there. With that Middle East tensions going to come heightened volatility. So that's what we're seeing, really. We're not seeing a massive change if we take a look at the charts. Okay. I mean, yeah, we're moving higher, but we're not moving like substantially higher. It's taken over about 4 sessions to move from 67 to 70. Really a 3-point move. Now, is a 3-point move? Yeah, it's 5%, but 3-point move on this is around 4%. So we're up about 4% in 4 sessions. Is that a lot? Well, it's not a ton. Okay, it's a decent move to the upside, but that's not what's affecting prices. We're going to talk about that, but it's all about volatility here. But I do like where oil is. I think it's putting in a nice little bottoming formation here. If we're looking at the weekly chart here, looking at the stochastic momentum, this thing's been bottoming and looking like it's starting to want to pop. MACD's increasing this week. RSI is starting to move up. Volume is decent this week on oil, so it's good volume. It's good volume last couple of days. So I think that's all really positive stuff for oil longer term. And if we're looking at the daily stuff, you can see that things are moving up on good volume as well, breaking above the 21 now, heading towards the 50 where we hit, as well as the top of the Bollinger Band. Bollinger Bands might be opening up a bit here. So we got some resistance. I would expect oil to maybe kind of chill out here a little bit. We'll see. We've got the Bollinger Band and the 50 EMA that we're running into here. But overall, fairly bullish looking move off of the lows. But what I want you to take a look at here is let's look at the oil volatility index. So this is the OVX. You can pull it up on TOS or in TradingView. This thing has been absolutely screaming higher, moving from 33 to 46 or so. That's almost a 50% move to the upside. So oil volatility has spiked about 50% from these rates that it was at, where it was kind of just trending sideways to down, and then boom, massive moves in oil volatility. Now, that's fantastic. If you're selling some options, to be selling in that high IV range, it's not great if you own options, and or if you're naked on calls or short calls. Now, we do have a strangle on. The volatility is not friendly to strangles because it's going to push the cost of your calls as well. It's not the move higher that's putting any pressure. Our strangle right now is I think a 90 and 54 strangle, and we're sitting at 70. We're like dead in the middle of the strangle, but the strangle's down. Why? Well, because volatility has expanded and it increased the puts and the calls of that strangle. So knowing that volatility is the reason behind that move, I'm pretty confident that I'm just going to let that thing sit here. Oil and every other trading asset out there, price can move in a direction. It can trend. It can trend for lengthy periods of time. However, volatility will always, always, always mean revert at some point in time. Usually doesn't take months for volatility to revert. It's going to revert usually in several days to a few weeks at the most for volatility to kind of revert and chill out a bit. So based upon that knowledge, just going to let this trades play out as long as we're not being threatened at all on any of the strikes. But I also think it's an opportunity if you want to look to trade oil. I think there's opportunities here to take advantage of this increased volatility. I mean, right now we're looking at an IVR of 96. on oil futures. Okay, which is why yesterday, even in the lazy trader account, and I'm going to talk about buckets in a little bit, okay, we actually did USO and we put a strangle on in there. Now, volatility cranked up a little bit more today, but we took advantage of this big spike in volatility yesterday to put on a strangle there. I will expect that now that volatility is moving up to a pretty lofty range, it typically doesn't get above this a whole lot and stay there, at least not on a longer term basis. Every time it's gotten here in the last year or two, volatility here has come down quite a bit. So obviously back in here, back in the 2022 timeframe, it spiked and then it chilled back out. Spiked, chilled back out, remained somewhat elevated, okay, but in relative terms, it really chilled out pretty decently. So I think that's what we're looking at here to see if oil, chills out a bit and reverts. All right, so there's oil. Let's talk quickly on gold. So gold had another just kind of sideways day. You're looking at, again, an overbought level on the weekly and the daily, popping up against the Bollinger Band, the 3 ATR band here. And now you're just starting to see this thing chilling out a bit and starting to consolidate. So I think that's something that we'll watch. Okay. Do we stay in this range for a while like we did back down in here and then finally broke up? So kind of a flag pattern, moves back up, consolidates, which is what you want to see. Okay, comes down and then breaks back out of this box. So we'll watch this volatility or this value area here, see if we stay in value, which is where we are right now. But you're losing a bit of momentum on the daily, and the weekly still fairly strong. I don't know how much more gold has upside right now without either chilling out a bit or pulling back maybe to the 21 moving average. So if you're not in it, which we're not, I'm looking for gold to come back down. And when it does, we're going to be ready to pounce, similar to where we were. And I'll be watching the stochastic momentum and some of these indicators as well here. Where do we bounce? Do we get down to these levels here where every time it comes down low and starts to move higher, we can get bullish. This one's been a nice up move since back in here. And not only does it doesn't always have to get into this oversold level, it's actually fairly strong when it only comes down a little bit and then cranks its way higher. These can be really strong moves. Okay, it doesn't have to, like this one, doesn't have to go all the way into that oversold. Either way, it works, and we'll keep an eye on it, but I'd like to see us get down somewhere into the middle range around the, at or below the 21 EMA. Then I think that's when we'll get back into gold. All right, so bonds. Let's take a look at bonds. Why are bonds being such a problem right now? Well, I think the dock workers strike has a lot to do with that. The longer this strike goes, the more pressure I think there's going to be on potential inflation and other things happening. Now, if inflation starts to pick up, okay, why? No, goods aren't moving, people aren't buying, economy is struggling a little bit. Okay? Inflation can be going up because they're not getting the supply they need. So because we don't have the supply, and the demand may be at least consistent or moving higher. Demand seems to be pretty good right now in the US for goods, but if supply gets hampered, that's going to cause some inflationary pressures, could throw a little bit of a monkey wrench into what the Fed's doing. Now, do I think this is going to be a long-term thing? Well, I hope not. And for the sake of not only the dock workers, I hope they get a settlement and they get that done. But for all the consumers and the US, we got to keep those goods flowing. So hopefully we'll see some resolution to this for everybody's sake. But these things can be tricky negotiations. But it's putting some pressure on bonds for sure. So, but what I do like is looking at the daily chart here. I pointed it out that I do like this uptrend line that we've been on, that we hit today. We bounced off it, finished well off of our lows. A nice hammer candle that we have here, or hanging man candle. So I do like that. Do like that candle in here. Can we bounce? We'll see what tomorrow brings. We did not finish at the high of the candle. We just finished well off the lows. We touched the Bollinger Band on the downside here today, and then bounced off of it. So you have the 50 moving average, the Bollinger Band, and the trend line all lending support here to bonds. You got MACD starting to try to curl up a bit, or at least slow the downward momentum. And then I love the fact that the stochastic momentum oversold and starting to potentially make that curl up. Now, the weekly, not as good of a picture. It looks a bit bearish in here. So we've got a, even though it's a bullish chart, okay, the more recent is a little bit bearish, which is fine. Let's get a pullback, okay, to the 50 or what have you, maybe around 123 or so and change, kind of where we hit today. Let's get a pullback in there, and then let's see what happens. But can we get down into this level? Sure. Let's see what happens if we pull up. Now, so I do still like bonds. I'm still bullish on bonds, and I will be probably adding to bonds on weakness here. So I'll be adding to bonds on weakness, but we're going to keep a cautionary eye on the strike that's going on. And then lastly, copper continuing its move to the upside. Great looking weekly chart. Okay, we're getting overbought, overdone in here to the upside. We'll see if copper continues its streak. How long is this China stimulus demand going to keep affecting things like gold, copper, silver, potentially soybeans and others? Silver as well. Okay, looking pretty good. Much more constructive chart, and I think good opportunities in silver here, bouncing off the moving averages, moving higher. All right, so that's enough on charts. Don't want to get too carried away on that, but really paying attention to mostly bonds and the S&P. Let's take a quick look at the account, and then I want to get into the buckets. All right, so briefly, let's take a quick look. Okay, not much change. We didn't add, didn't subtract, didn't do anything, didn't close anything out in our account. Another good day on our Aussie dollar strangle. This thing's just down a couple $100. So it's doing just fine as the Aussie dollar, which I didn't really get into the chart on that, but it's been backing off after getting into really almost an overbought area. Stochastic momentum starting to reverse, RSI starting to reverse, MACD starting to reverse. Is it the end? No, I just think it's a nice little pullback. It got a little ahead of itself with the dollar dropping as well. And with the China stimulus, the Aussie dollar is going to be positively affected by that. It will likely potentially stay elevated, but as long as it doesn't get too carried away, I think we're going to be looking at maybe some new strangles in it coming up, but we'll take the strangle for now. Oil, so this is the big one today. The strangle I talked about, because of the volatility increase, 99.7 on the IVR here for this particular expiration. This thing's down, but I'm not going to do anything to this trade since it's dead in the center of this strangle. So there's really nothing to do with that. It's down. We'll just let it run. But we've got a naked put here. This thing had, a decent move here. It's up 70% overall. So I like where we are on that particular one. We've got another naked put here. It's up 50%. And then we've got a 112 trade up 25% on the session. Losing some of that put debit spread that we had some gains going in, but I'm okay with that. I really care more about the naked puts paying off. ES, good day today. Markets were up fractionally. We'll take that. We've got mostly, our 111 trade, 112 trades on, a couple hedges rolling in here, and then a lot of put debit spreads starting to come off. And I'm going to post a video that Igor and I did. So Igor and I, my partner in Income Navigator, did a great video today where he really went through some of the different strategies he's doing and that we're doing together, how we're calendarizing some of these 112 trades, making that more effective, create a little bit more of a put debit wall as we go out there, adding a little more safety, a little more hedge, not really reducing our income, but making sure that you know how to adjust and manage your trades out there. The 112, as I call it, is like the Swiss Army knife of trading. There's all kinds of things you can do. You can reduce that put debit spread delta wise. You can increase the width of it, decrease the width of it. You can roll short strikes up. You can roll long strikes down. You can add it longer, farther out into the future. You can sell naked puts at a nearer expiration, at a medium expiration, a longer expiration. You can roll those puts down. You can roll those puts up for more income. You can roll them out into time if they're getting tested. So there's a lot of things that you can do. You can take some off, all off, none off. There's all kinds of things you can do. You can't just set it and forget it. Okay. If you want to maximize the income, you've got to be able to adjust those trades. All right. Gold, as always, we have a put debit spread. That thing's just going to sit there, do nothing. Bonds, again, taking that hit today. I'm okay with it. We're still up nicely on this naked put, left over from a 1-1-2 trade. Plenty of time left in that. We've got a naked call that's doing really well. This call is now putting out 37% in 13 days. So a great call, adding this call, good call on the call. Adding that to what we're doing here. We've also got a 1-1-2 trade that's just kind of sitting there. The put debit spread right now is in great shape. It's up almost $600. We'll keep an eye. If bonds start to reverse at all, I think I'm going to cash in on the put debit spread itself, and then we'll just let this naked put keep working. Again, the put debit spread, it's there not as a hedge per se. It's really there as a bonus income generator. And right now you've generated $600 in extra cash flow, which is fantastic. Naked put here, this one's down a bit with bonds being weaker. That's all good. And then we added that was just added yesterday. And then we added another naked put here. Again, down, it's all good. Not too worried about it. And then TLT, we've got some leaps that we bought, and we're selling covered calls on these. I'll probably close this covered call out tomorrow, seeing how we're doing. We're already at 73% in just 13 days into the trade. I'm going to take that off. Tomorrow we'll book the gains in it, and then we'll see if we get any kind of a bounce the rest of this week on TLT, heading into some big employment numbers on Friday. All right, so let's talk buckets. And let's talk about how you should set up your accounts to be most effective. So I'm going to stop sharing here and just talk to you guys as a real person here without it. Okay, but I want to make sure that you're setting your accounts up properly. So you want to effectively manage your trading capital, and you can help balance that between risk and return. And I want you to look at a 2-bucket system, which is going to allow you to separate your strategies into, again, conservative and a little bit more aggressive approaches, which is going to ensure that you're continuing to have steady growth and then the potential for higher income. So we'll talk about those 2 buckets. Okay. The third bucket, which I'm not going to cover today, would be your IRAs. Okay. Totally separate, different investing strategies. I use a mixture. I've got some 1-1-2s, some 1-1-1s, some futures, as well as ETFs and other income generating things in my IRAs. Okay. If you're going to trade the futures, obviously you've got to hedge significantly in your IRA. But to me, that's a separate bucket that we're not going to focus on here. What I want to focus on is the 2 core buckets that you should be looking at. Okay. Number one, and the one I'm not going to focus as much on, but that's our larger account. Typically, that's going to be a lower risk, steady growth type of account. Why? Okay. It should be a bigger pool of your money. Okay. This might not necessarily be your retirement nest egg, but it's probably pretty close. Okay. Maybe your retirement's sitting in your IRA, but you've also got a longer term, lower risk, steady growth account. For me, it's the lazy trader account that I share with you here. That's how I'm basically trading that particular account. What is that account made of? Well, we've showed you yesterday, and we continue to go through this account. I've got one account that I'm sharing with our members, and then obviously my own larger account. But this account is generating consistent, lower risk returns, aiming for about 18% a year, about 1.5% a month or more. Okay, I can take a little bit more if we're making good money in that account. Okay, but I'm using some more conservative strategies that are prioritizing capital preservation. All right, so number one, We're selling naked SPY puts in here. Now, you're thinking, oh, put selling, that's not conservative, Tom. Well, it is if you're okay with the underlying being a very high quality underlying. And if I'm looking at my account right now, and without going through it, because I showed it to you a million times, we're looking at Google leaps. We're looking at JP Morgan leaps. We're looking at MicroStrategy, which is Bitcoin. Maybe you think that's a little more risky. We're looking at NVIDIA leaps. Okay, we're looking at Schwab Dividend Equity, the SCHD leaps. We've got SPY leaps. We've got TLT leaps. Okay, we've got TMF leaps in naked puts in here, and then we've also got XLE in here. So we're also in energy. So most of those pretty solid, pretty secure companies that I'm okay owning. Okay. Right now, we don't really have stock in too many of those except for TMF. So we have a bond portion of that portfolio. Okay. Selling SPY naked puts, okay, while you may think it's risky, to me, it's not so much because I don't mind owning SPY. My good buddy, Tony Rehan, or Tony from Mexico, as you know him, I'm crediting him with this quote, but I'm stealing it and using it. He who dies with the most SPY wins. Okay, I'm okay owning SPY. I'm not retiring tomorrow. I've got plenty of time to go. So I'm okay selling SPY leaps, and I have a strategy for doing that. It's a campaign-based strategy. Every single Monday, I sell SPY leaps. Yes, I can stop out. I have a plan for that. But if we get down to where these are, which is like 20% below here, I would be willing to take assignment on a good chunk of these, depending on how many it is, the size of the account, the buying power being used. I only use a percentage of my account to trade these. About 30% of my whole portfolio margin accounts, only about 30% of those accounts use this strategy, okay, which gives me plenty of room to take possession of SPY. If I would get assigned on SPY leaps, I would be more than happy to wheel that thing and start selling covered calls at the money or so, as long as I get a decent return from them. If not, if I can't get a decent return, I'll simply hold on to those things until the market recovers. The market will recover, okay? It will recover most likely in my lifetime, so I'm okay holding those long term, and if I can, I'll be generating income with those. Okay, SPY leaps makes up the core for me, okay? I'm also holding T-bills in mass. Okay, for me, I use BIL, B-I-L. You can use SGov. You can just buy the actual treasury bills themselves and create a T-bill ladder. Different expirations, 3-month, 6-month, whatever you want to do, you can continue to buy and add those in. The great thing about doing that in a PM account is they are using up your cash, but they're not really holding any margin. Okay, they're almost holding no margin, like 1% of your margin. Okay? I'm doing about 90% of my account in BIL, which means it's only holding a small fraction of my buying power, which allows me, as long as I'm trading ETFs, not futures, okay, I'm able to trade those things. So I'm getting the best of both worlds. I'm selling those SPY leaps, generating cash and income on an asset that I feel is a high quality asset. I feel the S&P 500 is the best asset to hold long term. I will be happy to own a boatload of SPY. I think if you held SPY and you hold it, okay, you're gonna do great. And then I'm getting the extra income from having almost 100% of my account sitting in treasury bills. Okay, super safe, low risk asset, provides guaranteed returns. Right now, you're getting about 4.5% on those. Even if it drops to 4 or 3 or 2.5%, it's basically free money because it's only using the cash portion of my account and about 1% of my buying power. Okay, what do you do with the rest of the money? Well, I'll go up to about 50 or 60% total margin in this account with either ETFs or high quality stock names, the ones I just mentioned to you, selling leaps on those. And if assigned on a high quality stock, I will sell covered calls and I'll wheel those. Okay. Many of you know I don't like the wheel overall, but it's not the fact that I hate the wheel itself. It's the way I hate the way people trade the doggone wheel. Okay. Most of the time they're trading these crazy stocks. Back, a couple years ago, everyone was trading Mara and Riot and early days in Palantir and all kinds of these other crazy stock names that were low quality companies. Okay? And if you want to argue that they're not low quality or they are or what have you, these are low quality companies that have a ton of debt that could go bang or bust. I'm not talking about wheeling those. I hate those. You get assigned on those, they can keep going down forever. That's crappy stuff. I want to hold the premier companies of the world, the large market caps that have very little debt and potentially great growth prospects, maybe even pay a little bit of a dividend as well. Hey, some of those are your Mag 7s. Okay. Add in some banks. Okay. Add in some financials there and a couple other types of stocks. And I think you've got a great longer term portfolio. You can add Berkshire Hathaway, whatever. You can mirror what Warren Buffett does, any of those. Anyway, that's your safer trading account. That's the lazy trader account. I share that bucket with members. Okay. Bucket number 2, that's our trading account. This is higher risk. It's more aggressive growth. I'm willing to take more risk to have higher potential returns, 2-3% a month or more. I'm okay losing money. Everybody, I've made a boatload of money in that trading account. I've taken it from 30,000 up to about 500,000, back to about 350,000, and now cranking it back up again. Okay. Why? Because it's higher risk. I'm okay with the risk on these accounts. Okay. If you would tell me 4 years ago, 5 years ago, with a $30,000 account, it'd be worth 350,000 today in 5 years, pretty much sure that all of you would jump on that and take it. Okay. Everybody's focusing on the fact that it was at 500 and went back to 350. Well, you know what? We all have trading mistakes that we make. Okay. We got caught with a hole in our plan, took us back down a bit. Okay. We still have, okay, a massive growth, 10-bagger in our trading account. Okay. It's still in fantastic shape from where it was 5 years ago. I will take this every day of the week. Okay. We gave a little bit back 2 months ago. We're getting it all back now. Okay. So this is our trading account. This is not our long-term investing account. It's not our bucket number 2, which is that safer, slower growth bucket. Okay. You want to be able to take on some risk. It's trading. I'm okay losing some of that money. If you want to funnel money from this trading account into that other account, totally fine. My goal is to grow both of them for now until maybe I start to slow down or want to retire, or that account gets too big. Okay. And then maybe at one point, I'll start to roll some of it into the other safer account. Okay. But I'm willing to take that risk because that money is money that, yeah, I can afford to lose a bit right now because I knew I could grow it and I'll grow it again. Okay. And if you're a trader out there and you've been trading for 10, 20 years or more, every one of us can say that we've made a bunch and we've lost a bunch out there. Okay. Capital preservation is important. It's not like I'm playing a cowboy here and risking it all. Okay. Capital preservation, absolutely important to you. However, you shouldn't be bucketizing these amounts. Okay. And I'm not going to take all of my life savings and throw it into my trading account. Okay. Just because trading accounts can generate 3% or more. Okay. You got to be conservative with your bigger, safer account. Okay. I would rather make 1% to 2% a month on $1 million account. Okay. That's pretty doggone good. Okay. So for those of you out there with your $1 million account, if you're making 1 to 2%, you're making 10 to 15 grand a month. That's fantastic. Okay. You're going to make 12 to 18% a year or more. Okay. My goal is to make more than that. Okay. But it's not to make 30% in that account. That lazy trader account is built, okay, structurally to make about 1.5% a month, which is about 18% a year. The trading account is higher risk. I'm going to be more risky here I'm going to lose trades. I'm going to win trades. Okay. My goal is to generate close to 30% a year, but I got to take some risk to do that. So it's obviously risky if you're going to make more than 1 to 2% a month. You're taking on a decent amount of risk. What strategies am I using? Well, we're using the bear trap trades, the 1-1x trades, 1-1-1, 1-1-2, 1-1-3s, 1-1-2-2. However you want to set it up, that's perfectly fine. Okay, I've found that again, Swiss Army knife of trading, best trade strategy that I have found out there. Okay, we're also calendarizing some of these now, so I really like that. That's really starting to get me excited again. We are not throwing away the 1-1-2. It's a great trade. Okay, got a little bit of a hole. You got to solve the volatility piece, and I think we've done that. So I think we've come up with the best ways to trade it. Okay, but I'm not going to get rid of a trade that has grown my account by almost 10x in 5 years. Okay, and during the downturn in 2022, it generated 82% on the year. There's no reason to throw that trade out. Okay, just because we found a weakness in the trade that we didn't experience before. Now we solved it. Okay, now we're back in. We'll be making money. So we're also in that account. We'll trade naked puts. We're going to trade more on the futures and index side of the world, the SPX, SPY, futures, because we can get better leverage from that. With better leverage comes risk. Okay, are you willing to take on the risk? If so, fantastic. Okay, putting some hedges on. Having volatility hedges, delta hedges, absolutely requirement if you're going to trade futures. Absolutely got to do that. Okay? Keep your hedges on. Keep your size in check. Okay? We don't want to have a million naked puts out there. Okay, but I'm really focused on the S&P, oil, gold, bonds. That's pretty much it. Those four. Okay, the S&P normally my biggest piece, but right now it's oil, mainly because the oil volatility has moved up. It's increased my buying power in oil. But we'll be trading credit spreads, naked puts, and the 1-1-2 trades, 1-1-1 trades in there. So that's how we structure that particular account. That's what I found is the best trading methodology for that. Okay, that's how we trade. So overall, it's having these buckets available to you, separating. I see some other folks in some other discords going to a little more safety or a little more investment oriented. Perfect. Okay, you got to do what's right for you. Okay, for me, I don't want to just have an investing account, the lazy trader account. It's fine. You can make plenty, good money. Okay, 1.5% a month, something like that. A little bit safer. Although our stocks that safe if the market craters, if Trump wins, Harris wins, who knows what the market's going to do. Stocks can tank, stocks can go up, we can hit a recession, missiles can fly somewhere. There's no ultra safe way to trade. Okay, it all takes risk, but the investing account, you can lower your risk, lower your rate of return. Okay, there's a give and take there, and that's all good. That's why I call it the lazy trader, because I don't want to be in there every day shucking and jiving and moving. The trading account, I want to generate cash. Okay, that's the whole goal of trading. If you don't want to trade, be an investor, go buy mutual funds, do any of that. It's all good. I don't have a problem with that at all. Okay. But if you want to trade, you want to have some fun with this, you want to try to earn outsource returns, that's what we're doing. That's what hopefully I'm showing you guys here on how to do. So I'm giving you the two different buckets, my trading account every day, going through that, just went through it again. Okay, the lazy trader, which is my more investment oriented bucket. I want you guys to see how we trade those two buckets. All right, I know this is a longer video. I hope you guys hung in there. If you found this valuable, click the like button down below. Love to hear if you've got kind of this bucket strategy set up for yourselves or how you're using it. Okay, happy to hear from you guys. Enjoy a great rest of your evening. Take care, everybody. Bye-bye.